The retail financial market is built on everyday actions: swiping a card, depositing a paycheck, or transferring funds to a friend. These tiny, constant movements of money form the baseline of the economy. But where do those individual deposits actually go? Retail and commercial banks operate as the primary gatherers, pooling millions of these small personal accounts into massive reserves of cash. This board shows the Japan Post Bank IPO, illustrating how large alternatives to traditional banks can grow. These savings institutions, often called mutuals or building societies, are owned entirely by their members and were originally designed to pool community money for specific goals, like buying homes. The core mechanism for all of these gatherers is the same. They take in consumer deposits, pay out a small amount of interest, and then lend that money back out for mortgages or business loans at a higher rate. Your local bank branch is essentially a collection point. The true power of the financial system relies entirely on where this aggregated money travels next. Technology is shattering the monopoly of the old guard. Agile challenger banks now operate entirely online, providing nimble services without the massive overhead of physical branches. In developing regions, mobile fintech brings banking directly to populations that have never had access to a physical branch. A simple smartphone connection bypasses decades of slow infrastructure growth. Peer-to-peer lending platforms take this a step further, cutting the banks out of the equation entirely. They connect borrowers directly with savers. The savers secure higher yields, provided they are willing to accept the higher risk of default. This explosion of digital alternatives has rapidly expanded shadow banking. This ecosystem consists of non-bank institutions performing traditional lending and credit services, largely outside the strict regulations that govern standard banks. Whether your paycheck lands in a century-old vault or a brand-new smartphone app, those pooled retail deposits have to cross a critical threshold into the B2B world to actually fund the global economy. This visualization maps out the wholesale market, the massive business-to-business sector where governments and public corporations raise capital. The first major aggregators are pension funds. They collect everyday workers' savings to create giant pools of long-term investment capital worth trillions of dollars. But capital requires direction. Institutions hire professional fund managers to steer these massive reserves. These tacticians analyze the global economy and execute specific investment strategies, buying and selling assets to generate growth. In exchange for managing the risk, they take a percentage fee of the total funds under their control. Having billions of dollars and a manager to direct it solves only part of the equation. When a corporation actually wants to issue new stock or acquire a competitor, the system requires specialized architects to build the deals. Investment banks step in to fill this role. Despite the name, you cannot open a checking account at an investment bank. They do not hold consumer deposits. This graphic illustrates their distinct core functions. They advise on corporate finance, arrange initial public offerings, and structure complex mergers and acquisitions. To support these deals, they run massive securities trading operations. They provide the brokerage facilities necessary to buy and sell millions of equities, bonds, and derivatives at scale. Because their operations are deeply intertwined with the global economy, their failures pose severe systemic risks. Consequently, their most aggressive proprietary trading activities now face heavy restrictions under modern regulations, like the Dodd-Frank Act. Investment banks execute the trades and structure the financing, but they rarely hold the underlying assets permanently. That leaves a massive vulnerability in the system if the digital paperwork isn't secured. With trillions of dollars flying between managers and investment banks every single day, who actually holds and protects the assets? That responsibility falls to custodians. They operate as the hidden, highly secure vaults of the ecosystem. They provide safekeeping for equities, arrange the settlement of trades, and collect income from underlying companies to route back to investors. Their most crucial systemic function is reconciliation, often called trade support. They constantly audit the accounts, ensuring that the digital assets a fund manager expects to hold perfectly match the actual securities locked in the vault. Without custodians performing this exact reconciliation, the interconnected web of global wealth would instantly lose track of itself, causing the markets to freeze. This diagram maps the complete journey of capital, gathered by retail banks, pooled by pension funds, and directed by managers. Corporate deals are structured by investment banks, and the assets locked down by custodians. This hidden digital network has a direct physical impact. It dictates which companies innovate, which governments build infrastructure, and how rapidly cities expand. The global economy is a highly specialized relay race. It takes an individual's everyday savings, hands it meticulously up the chain, and uses it to fuel the explosive growth of the physical world.